Hello and welcome to a special panel discussion from The Spectator, sponsored by Netwealth, the investment advisory company. I'm Fraser Nelson, editor of The Spectator. We're just a week on from the Chancellor's budget, which gave us the highest tax burden in 71 years and quite a few surprises, mainly the kind of volatility and how different the economic outlook is now from what it was just a few months ago. The true test for Rishi Sunak will be in the coming few years. But while the global economy is now going in all kinds of directions, it's not clear at all what the future might hold. Is this now the time to invest in the stock market? Is this now the time to get out, with a number of fund managers expecting a significant crash within the next few years, or months even? So where do we go from here? I'm delighted to be joined by Gerard Lyons, who is a former economic advisor to Boris Johnson and also economic advisor to Netwealth, and Louise Cooper, independent financial commentator, who many of you will know from the Spectator's pages. So I'd like to start off, Gerard, by just asking you how you see the broader economic outlook right now, because after the pandemic, it wasn't sure if we were going to fall off a cliff, if we're going to come booming back in a V-shaped recovery or somewhere in between. What's it looking like?
Well, first and foremost, it's great to be here, so good evening. Maybe sort of three key messages to sort of kick off the evening. First, in the very near term, I think one should be wary of the outlook in the sense that there's going to be considerable uncertainty and therefore in terms of the markets, a lot of volatility. At the moment, markets are really impacted by a combination of factors. Health and geopolitics have the possibility of resulting in extreme outcomes. But apart from those, the markets are very much focused on the economic data and the policy outlook. And in terms of your question, over the last 6 months, we've seen a complete evolution in the market. 6 months ago, markets were focused on strong recovery, rebound, with policy really helping. Then we saw a move towards a greater concern about inflation. And more recently, the concern has been not so much about inflation or the strong growth, but more about a deceleration in activity. America's lost momentum. China's in a growth recession. So in the very first key message is near-term uncertainty, undoubtedly. But the second message is despite all that, be very positive about the longer-term outlook. The world economy has a lot of positive underlying drivers. Challenge for us in Western Europe, including the UK, is many of these drivers are likely to be more positive for other parts of the world. So we need to really reposition ourselves to sort of benefit from this. So the Indo-Pacific is emerging as the strong growth region of the global economy.
So, but Indo-Pacific, just to be clear,
from India in the west to America in the east.
So we're talking India, China, Asia, basically, all of that side of the world.
Absolutely. And then on top of the Indo-Pacific being the growth region, the other key underlying dynamic, and certainly evident before the pandemic and likely to be so now, is the digital and data revolution. So companies here in the UK and indeed in the West can still benefit from that. So the first message is near-term uncertainty. Second, despite all that, lots of positivity in my view, the Indo-Pacific and the digital data revolution. But the third, coming back to your question about the outlook, UK assets are undervalued, but the reason for that is partly because there is a lot of uncertainty about UK growth prospects. And what we really need to have here is a pro-growth economic strategy and the government basically outlining the sense of direction and direction of travel. So the economic...
The highest tax rate in 71 years, would you describe that as a pro-growth strategy?
No, but the high tax rate needs to give way to a low tax rate in the future. We can talk maybe, I don't want to take up all the time here, but I think there's lots of areas. In terms of the UK, at Netwealth, I argue that we need to have a three-arrowed pro-growth strategy. One is monetary and financial stability. And at the moment, in my view, the Bank of England is neither on top of monetary nor financial stability. Second arrow is credible fiscal activism, which means reducing debt to GDP over time, and not through higher taxes or spending cuts, because that's like being in a hole and digging deeper, but getting debt down by growing the economy. And the third aspect is the whole supply side, all the I's: investment, innovation, infrastructure, and incentives, which, coming back to your question, Fraser, incentives to get the economy going need smarter, lower regulation and smarter, lower taxes.
Well, if you're still Boris Johnson's economic advisor, I imagine you'd be having to resign right now. I can't see him taking much of that advice, but let's continue that later. Louise, tell us how you see things. Are you as optimistic as Gerald here?
So I take a very long-term perspective when it comes to investing.
By long-term, we mean,
decades.
Just to be clear, decades.
Yeah, decades.
Right.
So I'm 51. Maybe I might live until I'm 80. Historically, you make money in the stock markets by looking long term. You don't make money by trying to time a market. I get in this month, I get out next month. I buy this 6 months, and then I sell in 6 months. That's not how you make money. Trying to time a market, oh, it looks expensive, let's sell a bit. Oh, it looks cheap, let's buy a bit, is utterly impossible. Almost no one can do it. Many will pretend they can, but they can't. So you need to have a very long-term perspective. So let me just give you, we've had two economic crises in, just over a decade. That's pretty extraordinary to start with. We had the global financial crisis, and now we have the economic crisis from the pandemic. In the global economic crisis in 2008, just a little bit of history lesson, the S&P 500 in the States lost 37%. It lost a third of its money in a year. Everyone was like, oh no, scary times. Actually, that was the most fantastic buying opportunity because the S&P has gone up over 600% since. Let's look at the beginnings of the pandemic. End of 2019, beginning of 2020. Global stock markets in crisis, in chaos. Fear drove the markets. The S&P fell 20-30%. The FTSE fell 20-30%. Again, fantastic buying opportunity. When everybody else is fearful, that is the time to be greedy. So stock markets, you look for the long term. You don't try to time it in and out. That's not how the markets work. And the data, Gerard will back me up here, the data proves that.
Right, so generally speaking, you're saying you're optimistic, you're saying it doesn't matter if you're optimistic or pessimistic because in 2 or 3 decades, and that's your sort of...
Well, even in 5 years, like you cannot... It is true the US stock market is expensive.
Yes.
It's true the UK stock market is really quite cheap. But ever since I've been in the markets, and I go back, not possibly quite as long as Gerard, but almost, I go back to 1992 when I started as a broker at Goldman. And we had a very famous strategist called Abby Cohen, and she kept saying, buy the US market every year, 92, 93, 90. Oh, it's expensive, it's expensive, it's expensive. Yeah, you can't be out of a market just because it's expensive.
Okay, but let's talk about perhaps the biggest risk factor in everybody's minds right now, and that's inflation. Inflation is something we have not seen for some years. I remember Roger Bootle describing the end of inflation as if it was now. But what we're seeing now is that in the space of just a few months, there, but and then now we're looking at the last one shows 4%, and it might even be higher than that. Some people are talking about 6%. Now, if they can get it so wrong in the space of a few months, what might it look like in a few more months? And if there is inflation, then what do you do? What can one do to protect one's assets against it? I mean, the FTSE is still pretty buoyant, having recovered from its slump. By the way, I think everybody was amazed at how quickly stocks recovered. Even before the pandemic was over, the market seemed to think, well, the vaccine's going to come along, we're going to get out of this. And then typically after pandemics or after similar disruptions, it's a good time to invest. But right now, you're saying, Louise, the American market's about as expensive as it was at any time since the beginning of a dot-com crash. So if inflation does come along, then what happens? Do stocks go up or do they go down?
Well, before you actually answer that, you need to actually understand what type of inflationary problem we currently have. And that's the key issue. In fact, when you were saying about the OBR's forecast, in fact, they should have known better, the reality. But the interesting thing is that we know from the past that when inflationary pressures change relative to expectations, the market is normally on the back foot. In the early 90s, for instance, we moved from high to low inflation, and the markets were really slow to adjust. They didn't realise the emergence of China and globalisation was going to change the inflation outlook. So the markets then kept thinking, oh, the dip in inflation is going to be reversed. The opposite happened in the early 70s. Then the markets were caught unawares when inflation really took off. So that's the challenge at the moment. If inflation really starts to pick up, then it's likely that the markets will be lagging, not leading. So the question is, what type of inflation problem do we have? And I tend to say, which P is it? Is it going to pass through quickly? Is it going to persist? or is it going to become permanent? Now, the central banks, including our own Bank of England, say it's not going to be permanent. They think it's transitory. I think they're right, partly because of globalisation and the factors we've touched on. The challenge, though, is they all think, the central banks, think it's going to pass through quickly. And I think they're wrong. It's going to persist for a year or two, in part because we have lax monetary policy, and in part because some of the factors that have contributed to this pickup in inflation are now allowing people naturally to argue for higher wages. They're allowing companies to increase their pricing power, build their margins. So we've got a persistence of inflation. So in that environment, in terms of how markets react, it's not only linked to what type of inflation we get, but the policy response. And if the policy response is credible and nips inflation in the bud, then markets, after the initial adjustment, which might be slightly painful or volatile, will then rebound. The challenge we have at the moment is the exit strategies from central banks, not just here in the UK, but elsewhere, are far from clear. And given that they aren't conveying that sense of sort of being sort of ahead of the game, reading the road ahead of them, that makes the markets very nervous.
So you're talking, Gerard, about one of the bedrocks of the current instability is not just how we recover from the pandemic, it's what inflation does, and also take the central bank's balance sheets, not just in Britain, but in Europe and Japan. They've been all printing money like nobody's business. So the money printers have been on overtime. And when this happened after the crash, people like me said, well, there's going to be big inflation, a big price to pay for this. And the RPI went up, I don't know, peaked at 5% I think afterwards, but CPI was relatively low. There wasn't really that much of a price. So this time around, when the Bank of England and most central banks looked at it, and you can see on the graph here how the central bank balance sheets have jumped from about $15 trillion to north of $25 trillion.
Yeah. Well, yeah, the CPI, the joke used to be that CPI should be renamed the China price index as opposed to being called the consumer price index. Such was that disinflationary impact of China. And we've had those global competitive pressures really sort of contributing to a low inflation environment.
China's getting pricier now.
Yeah, that's right. And central banks here, you see, this really changed in the wake of the 2008 global financial crisis. And this, you argue about this in terms of inflation. The greater worry in my mind is what this means for financial stability. Because when central banks have interest rates close to zero, that means markets are not pricing for risk. There's this mad search for yield. And it happened before 2008 as well. Then we had low interest rates. Since then, we now have the additional problem. Central banks are now the biggest buyers of government debt. Here in the UK, in the States and on the continent, the central bank is now the biggest holder of their respective national debt, or obviously in the Eurozone it's more than one country. So that creates a challenge because it means that bond yields are not reflecting true demand and supply. Their biggest buyer is a non-commercial player. So what we have here is that central banks' actions are helping feed that inflation problem. It means there's a greater danger that inflation, instead of passing through, persists. But central banks' actions are creating this situation where markets for the moment are benefiting. Markets are discounting the good news. Markets are assuming that central banks will always tell us what's going to happen. Therefore, we can always exit in time. But the challenge is that central banks' actions, both in terms of low rates and buying government debt or printing money, is creating greater instability. So there's two challenges here, not just the inflation one, but the financial instability one, which doesn't mean that we shouldn't be positive about the longer term. I think we're both in agreement. There are a lot of longer term positive economic drivers, but it creates that additional near-term uncertainty.
So, Louise, in this uncertainty, isn't the safest thing to do to basically put your money in a cash ISA? At least you know it's going to be there.
So the problem we have, as Gerard explained, right, is we've had pretty much zero interest rates since the first crisis, since the global financial crisis. So central banks cut rates to effectively zero. But we've had inflationary pressures since then. I'm also slightly more bearish than you on China because of the frictions on global trade. Anyway, but I'll come back to that. Yeah. So essentially what you've had is zero nominal interest rates, and yet you've had inflation. And so let's just look at that chart. That is the cash ISA return.
In real terms.
In real terms. So in real terms, if you had left your money in a cash ISA since 2008, you would have lost 10% of your money.
In real value, yeah.
In purchasing power. Now, why would you ever leave your money somewhere where you are effectively losing purchasing power, losing money in real terms. And this is what you have. So we talked about government debt. So the UK government can borrow 10-year money for 10 years at 1% a year. Inflation currently 3.5%, could get to 4.5%, could get to 5%. So bang, in 1 year, I've lost 4% of the purchasing power of my money. Why would I do that? Germany, right? We all know Germany's got negative rates. German government can borrow for 10 years, doesn't need to pay you any interest at all. German inflation has reached a 30-year high at just over 4.5%. Spanish inflation, a 30-year high, 5.5%. These are all, the latest figures. So why would you ever invest in a fixed income asset, in a bond market, putting your money in savings when it doesn't even keep up with inflation? I mean, there's gentlemen may prefer blondes, but they definitely don't prefer bonds.
Very good, very good.
Did you like that, Gerard?
That was very good.
Right.
Yeah, so don't put your money in bonds.
But
don't put your money in a cash ISA.
Right.
What's really interesting, I was going to say, is
you can get inflation protected inflation. I mean, and I think a quarter of UK bonds are linked to inflation. I mean, Louise is here. I guess what your argument, Louise, is back in the day, interest rates would always keep you ahead of inflation, but they don't anymore. You can actually go down. So you're actively losing your money. We get that. Of course, the answer to why would you put it there in the first place is because I suppose you might think the downside of inflation would be not as bad as the potential downside of a stock market crash.
It's very interesting you say that, because the catchphrase immediately after the global financial crisis, I say immediately after, it lasted for a few years, was that people were not looking for a return on their capital. They were looking for a return of their capital. They were so cautious, they didn't mind about not getting a return on it. But the graph that was shown on ISAs is quite interesting, because what's staggering actually is how many ISAs are actually in cash. And the challenge is, obviously, if someone's watching this and they're hearing us talk about near-term risks, the challenge is that people might think, oh, I don't want to put it in the market. But the reality, and it comes back to your initial point about timing the market, the phrase people say is time in the market, as opposed to timing the market.
Absolutely.
Sounds very difficult to say that easily, so it doesn't get muddled up.
You try saying gentlemen prefer bonds.
Yeah, that's right.
You try saying that.
But the reality is that you need to almost bite the bullet. If you think the markets are about to crash, then obviously you're going to be cautious. But time often shows is that it's best to actually put your money to work and think longer term. For instance, last April, April or May, just when the markets had crashed. What was staggering, at Netwealth, we were very much taking the longer term view. How many people were trying to double guess that the markets were going to fall further and further, and then the markets turned around? You can get caught out by trying to micromanage in the very near term.
Just don't bother.
But let's zoom out and look at some of the bigger trends. So
Yeah,
earlier
of
on,
course.
you were talking about the Indo-Pacific region, in other words, effectively the Asian economy.
America really comes into this because it's trans-Pacific. America is very much looking towards East Asia. So it's in geopolitical as well as economic and financial terms, the balance of power has moved from transatlantic to trans-Pacific. And India as well, if you go even further west, so to speak, changing your map of the world. So India over to the States, and it's really quite dynamic. China, sort of Northeast Asia, Southeast Asia as well, ASEAN.
We can certainly see what portion of the world economy was occupied by the Indo-Pacific region. But that's something over the last 20 years. We have really seen an increase in that. I guess the question is this likely to continue? Yeah. Do we think that Asia is the investment future? And if you might think, OK, we don't know the exact moment, but you can choose your geographical region. It's very easy now to go to any fund manager and think, OK, I think that Asia is going to have the next decade, the next 2 decades. People might have seen these figures saying that by 2050, the GDP of China will be far bigger than America right now. And if you want to invest until you're 80 years old, as Louise is saying, certainly for the next 30 years, you might think to yourself, well, China is where it's at. Now, you seem, of course, you're an advisor to the Bank of China here, but on the other side, you've got China's demographic kind of death spiral right now. Yeah. There are real problems here, where it's difficult to look at that country and think in 20, 30 years' time, they're going to have a bit of a worker to pensioner ratio problem. The government's asking the Chinese to have more kids, but don't seem to be doing it. You spoke about a Chinese growth recession right now. In other words, that China's growth is basically getting slightly smaller year on year. So can we really be sure that for the next 20 years, or rather, how do you think they will stand in comparison to the last 20 years when it comes to Asia's share of economic growth and where an investor might put his or her money?
Obviously, any investor can choose a particular country or particular region if they want to, and good luck to them. But I think one needs to also recognise the global story and the diversification. Let me quote 3 figures in this context. Here in the West, we are constantly pessimistic, it seems. We're constantly talking about the problems. But 3 figures, 31, 62, 102, 102. At the beginning of this century, the world economy was just over $31 trillion in size. The day the financial crisis started, the global economy was up to $62 trillion in size. Based on the International Monetary Fund's projection for next year, which seems pretty credible, next year the world economy will be up to $102 trillion in size. The point is that despite all the challenges, the world economy is continuing to get bigger. A small amount of that is inflation. The vast bulk of it is real economic activity. And it's inspiration and perspiration. Perspiration is demographics, which in some countries are a dividend. Some places might be a disaster if you don't plan for it. But you're right, China's growth rate will slow because its population will age. So China, therefore, needs to move from the perspiration to the inspiration part, moving up the value curve. In some respects, that's what we need to do as well here in Britain. Inspiration, hence last week in the budget, it was all about science, etc. So the combination of factors, but when you put it together, the global economy has done really well despite the challenges that are hitting certain parts of it, particularly here in the West. But in terms of China, yeah, its dynamic is slowing. It's the second biggest economy in the world, but in terms of income per head, it's way down there, 70 or so. India is really interesting. 1 in 12 people in the world is an Indian under 27, which is quite dramatic. If India gets its demographic dividend right, then it suddenly has the ability to propel itself. And if we went back 20 years, India and China both had the same income per head, or just over 20 years ago.
Right. But see, India's still got something like 150 million people in poverty. I mean, this is a country which is basically so many things. Do you think India is going to be the next China? In the last 20 years, China's poverty level went from, I think, in the last 20 years, from 68% to something like 0.8% now in extreme poverty. Incredible progress in the space of just a couple of decades. Do you think India is going to do the same thing?
I think India will probably beat people's expectations, but I would be surprised if it matches up to how China has done in the last 20 years. But I would be more positive than maybe the consensus is about India. But the point is that the demographics become a dividend if you get it right. They become a disaster if you get it wrong. But in terms of coming back to your question about trying to pick the regions of the world, there's no doubt that when one looks across the Indo-Pacific, there are parts of that region where the demographics could be a real positive, but there are also parts of that region where it's going to be the inspiration side. For instance, India's size of India's economy is the same if you take the 10 economies of Southeast Asia, ASEAN. Their collective economy is the same size as India. Now, that shows that when we look at Asia, we often talk about China, we don't always talk about India, we don't talk about Southeast Asia. South Korea, some people watching will think, India's never going to do it. South Korea is a good example. In the 50s, South Korea was the size of a mid-African state. South Korea is now the 12th biggest economy in the world. It obviously got its policies right, and the private sector came to the fore. But those success stories have been seen in a number of countries over the last few decades. So one shouldn't always be too sceptical, but sensibly one shouldn't just assume everyone is going to do it. Africa is really interesting. When I was chief economist and head of research at Standard Chartered, I used to go across Africa, and in fact I think we totted up once. I went to 84 countries on business. Some of them you would get to, you'd look at the data, think great, then you get to 1 or 2 countries and you'd have this deep intake of breath and you think, how are they actually going to realise their potential? But often it requires credible policies, real solid politicians. Some people do make it, some don't. But the point is that you shouldn't generalise, and we need to be quite selective as well.
Louise, I guess if you think that the future is uncertain, you might think you never know when's the up or down time, but you might think, okay, do you invest, do you look at geographically, or do you think about sectors? Do you think I want to go to the tech sector or the property sector? What's your overall approach?
So, there's a couple of things, right, to always bear in mind. An economy is not the stock market, okay? So just because an economy is growing doesn't mean the stock market will do
You
fantastically
need
well.
to find out whether the shares in that country are expensive or cheap. We're saying America is expensive.
Well,
Britain's cheap.
no. I mean, the vast majority of an economy comes from small and medium-sized companies that aren't quoted on the stock market. So the big thing you need to remember is the economy is not the stock market, OK? So that's the first thing you need to remember. Secondly, with China, I'm probably not quite as bullish as you, Gerard. So there's a few things that concern me about China. So first of all, the rules of the game, OK? The rules of the game in China are not the rules of the game that we play here in the West. So just look at the collapse of the major property company. I've forgotten what it's called now. Evergrande, that was it. So if you look at that, there hasn't been that much detail. There hasn't been the way a collapse would happen, a bankruptcy would happen here in Europe, right, or in the States. So that makes me very nervous about going gung-ho into Chinese stock markets. And also, when I was
I think that's right. Sorry.
and then also when I was a stockbroker at Goldman all these years ago, probably the only UK fund manager that can credibly hold his hand up and say he's comparable to Warren Buffett, Anthony Bolton from Fidelity, astonishing long-term returns over 20, 30 years. He went to China, blew up his returns. Why? Because the rules of the game are different. And if you don't know how the game is played, it's really best not to try. And then there's other issues about China's economic data. We know it's manipulated. We know it's not really accurately reflecting it. And then there's other issues about China having this big boost to growth since joining the WTO. There's a whole load of things that it cannot replicate. And so exactly. And so that's the other thing about when you go back to the inflation and it's going to be transitory, right? Well, one of the big things, as Gerard explained, is that China has exported deflation to the rest of the world. It joined the WTO and is now exported deflation. There are many reasons to suggest that may not happen. So, I mean, again, so when you look at inflation, I, like you, have been predicting we would have inflation for some time, Fraser. I clearly have been wrong. Everybody always thinks it's going to be transitory. And I am currently thinking...
That's why the central bank should be taken. It's interesting, your point about
I don't
China.
know if it is going to be transitory.
I think the key message I would give to the viewer about China is that the trend will be up, but we should expect increasing volatility along the way. The real challenge is this: the size of the Chinese economy is so big now, and you've touched on the key point. The policymakers and the government, still trying to run it from the centre, and it's greater challenge to do that. So one should expect greater volatility. The trend rate of growth will slow, i.e. will be growing at 4% in 5 years' time as opposed to 10% 5 years ago. The size of the economy will be bigger, but more volatility. Governance, as you touched on, is an issue. But the interesting thing is that the Chinese are really deepening and broadening their bond market. So in terms of financial markets across the globe, investors are looking at the bond market in China. The currency is a different issue. But the challenge, of course, is that for all the reasons you've touched on, people don't necessarily want to invest in China, but they want to invest in companies that will benefit from the sort of spin-off, shall we say, the global aspects. And the technology side is very much still driven by America at the moment as well, which is partly why the US markets have done so well.
We've got quite a few questions from our viewers coming in, and if and do keep sending them in. There's some good ones here. I guess Richard asks, what about, we're speaking a lot about basically about equity funds as if that's the only real option. What about alternative investments? I mean, commodities, for example. Should you be thinking in terms of that if there is going to be this hunt for resources right now? Do you think it's time to expose oneself to, I don't know, to gold or silver or other such things?
Well, the answer to that is which type of commodities. So in terms of Richard's question, I would say that one needs to differentiate between the financial commodities, the gold, silver, shall we say. Then there's the so-called dirty commodities, oil related, and then there's the sort of resource type commodities that are not dirty but are not financial. And the interesting thing at the moment is, of those, people have looked at the gold aspect, and naturally gold has a natural affinity for some people. It's seen as a safe haven, although the safe haven status is always called into question. But oil prices are quite significant at the moment. I use the word significant again. Oil prices have risen sharply.
$20 a barrel to 80.
Yeah, and likely to go well above $100 per barrel, I would argue. And the green agenda is vitally important, very sensible to focus on the green agenda. But sometimes when you have people focusing for all the right reasons on a certain area, there are unintended consequences. And one of the unintended consequences has been maybe a lack of investment in some of the fossil fuel areas, which, given that we still have a world economy driven by fossil fuels, oil has not received as much investment as it should.
You think that the green agenda, which makes it more politically controversial for companies to be drilling for new oil supplies, means there's going to be the supply-demand ratio will, thanks to the green agenda, be skewed in such a way as to make oil a lot more expensive.
Yeah, some people in the oil industry were saying the very same thing 6 months ago when oil prices were far lower, that we have challenges. When one looks, in terms of the green agenda, to put my cards on the table, I've been on the advisory board of the Grantham Research Institute on Climate Change and the Environment since it was set up over 10 years ago. The good thing now is that people talk about green going hand in hand with growth. But people almost become too optimistic about what can be done. To move a fossil fuel economy to net carbon zero by 2050 is a huge ambition. And so still at the moment, base load of fossil fuels is high, base load of renewables is sort of low. And therefore, as we saw in the last few months, wind production is output is. So the point is that, coming back to Richard's question, commodities, we've seen commodities are very much driven by the cycle as well as by some of these underlying factors. So yes, they should be considered within a portfolio.
It's also quite a specialist thing to do, isn't it? I mean, is it an easy thing to do? Can you buy into an oil-linked fund or a
commodity funds, aren't they? Yeah, they're commodity funds. Yeah.
You can always find the specialised funds. At Netwealth, we focus very much on sort of being diversified. So if you wanted to go into specialised funds, yes, these are always available.
I would caution that the oil price has gone from $20 to $85 in 18 months. The copper price has soared. Many of these commodities have rebounded very strongly as the global economy has. I mean, the time to buy them would have been 12 months ago, not now. I mean, it's kind of slightly bubble at the moment.
Well, Louise, there's a question to you from Jenny here. She's quite struck by what you were saying about ISAs. I've got quite a lot of money in an ISA, she says. Should I be taking my money out immediately? Equity
ISA or a cash ISA? So,
well, no, is the answer. Look, if your money's
in... But wait, Louise has just told us here why would you... Posed a question. Why would you want the real value of your investment to go down 10%?
So
I was sorry, apologies.
How old is she? Not the first time. I'm totally teasing you, Gerard. So it depends on your horizon, and it depends on your attitude to risk, and it depends on your understanding. So I've spent 30 years in financial markets, so I have a very deep understanding of the risks I'm taking. I understand that long term, the S&P 500 gives you 7% a year. There's a dividend of 3 to 4% on the FTSE. I literally do not care what stock markets do month by month, year by year. It has no impact on me whatsoever. But I know that because that's my years of experience. If you're somebody who, in the midst of the global financial crisis, when the S&P was down 37%, went, oh no, and sold your equities, or if you were somebody who, in 2019, 2020, at the beginning of the pandemic, saw the FTSE crash from 7,000 to 5,000 and go, oh no, I need to sell my funds, then you should not be in funds, all right? You should not be in the stock market. If you go, the FTSE's down 30%, doesn't bother me at all, I'll load them up, I'm invested for 30 years, I really don't care, then absolutely you should be in the stock market. But the stock market is quite a psychological thing, right? You really should have the knowledge and I'm very data-driven, I'm very analytical, I'm very logical, so it doesn't bother me at all. But if you're somebody who is going to be spooked out of markets, and all the research shows that most retail investors, most people, will look at a collapsing market and sell. What you should do is look at a collapsing market and go, do you know what, it's damn cheap now, I should be buying more. But not everybody thinks like that. And in fact, most retail investors don't.
Right, but say for example, I'd like interesting question to both of you. We're looking at somebody who's got, I don't know, say £10-15 saved, so £15,000 saved. Off that money, what proportion would you think is safe to put in equities? Would you say you're daft if you've got none in funds?
At the moment, we both agree the UK stock market is screamingly cheap. But it's been screamingly cheap for quite a long time. Yeah. But I'm happy. So what you need is a very diversified fund. So I own Vanguard Life Strategy Fund. It probably owns about 5,000, 6,000 shares and bonds. There you go.
And this is
that's my Vanguard Life Strategy
Fund. There are several. Vanguard, of course, a rival to Netwealth.
Second biggest fund manager in the world. Astonishing company. Big fan.
Right. And they, you can buy their fund. Basically,
it's
saying it's like 20% equities, but you've chosen 80% equities. That's your fund.
But then I'm punchy. I understand risk.
Right. But we can see it here now. So then, if you look at it over the last 10 years, it's gone up by 150%, or adjusted for inflation, 107%. In other words, doubled your money. That's not bad, compared to down 6% in real terms for a cash ISA. So that's what you would have done. But then again,
so it's very diversified. It's thousands of stocks, not 100, thousands. It's diversified globally. So I'm not trying to pick Asia Pacific or China or America. It's very diversified globally, but it does have a home country bias. I think 40% is in the UK, which I'm kind of happy with because the UK is very cheap. The trouble with markets is markets can stay cheap for a long time and they can stay expensive for a long time. But all I want is an extremely low cost. This is what most people don't understand. You have to have low fees. And I'm paying about 30 basis points, about 0.3% for those funds.
You mean, so
every
year, the fund manager
fees.
will take 0.3% of your entire portfolio and charge that as a fund.
Yeah.
And this is a metric. Now,
fees are key for long-term investing because fees compound. So returns compound, fees also compound. So low cost, heavily diversified, globally, stocks and bonds. And because I understand risk, I'm more than happy with 80% equity.
Okay,
you should work for Netwealth. That's similar to the storyline we keep telling.
He's offered me a job.
But I think it's only fair that as our sponsor, you should talk about this. And Netwealth was set up 5 years ago, relatively young, and your advertising slogan, which I've seen quite a lot in The Spectator, is that we will make you a fortune, we won't cost you a fortune. Yeah. So what is Louise missing here? What Netwealth fund should she be investing in here rather than?
No, Vanguard's very good, actually, but it depends what you're looking for. In terms of Netwealth, you'll give me a chance to advertise, so to speak. We would be offering Vanguard plus more. We would be a service. So if you want to have low-cost, simple investments, then certainly Vanguard, but you can do that in Netwealth. But we're a service as well. So if you want to actually have some advice about your portfolio, if you're coming up to retirement, if you want to pass your wealth on to the next generation, or if you want to manage your retirement well, if you want to manage your ISA or your pension, then we provide that type of service. But one of the key issues that we do, we actually have very low fees. So relative to the market in the UK, we would probably be saving you just over 1% per annum. So you're right, your point about the compounding. So over a decade, we would probably, on fees alone, save you about 15%. But on top of that, you want to be open and transparent. So we have performance that is always versus our competitors, which is the ARC, we aim to outperform by doing, as it says on the tin, something simpler. So we have 7 sterling portfolios. So since its inception just over 5 years ago, our portfolio 7, which is primarily equities, is up 69.5%. Our portfolio 4 is up 44%. So, but people can see this online if they want. But coming back to the earlier point, it's about controlling the controllables. The lady asked the question about whether she should be in the cash ISA. When I said no, the point I was referring to was don't take your money out of ISAs because that's one of your controllables. You can minimise the cash. We can't predict how the markets are going to perform, but there are certain things that you can control. And at Netwealth, we try and argue that, look, we help you control the controllables. And so Vanguard, very good if you're looking for that. Netwealth, very good if you're wanting a service and you want to have Vanguard, yes, but also you can have more. That's the point, really.
Yeah, so
but I think
what the service you're paying for is
it's very
stopping you selling when the market is crashing.
Or giving you advice as to how to manage your tax and other issues. Right. So the bulk of our money from clients is in pensions or ISAs. And that's quite interesting.
And so the other thing, if you are worried about a toppy market, and to be fair, I'm sure you'd agree with me, there are things that make me think stock markets are toppy, particularly America, right? The fact that Tesla is now valued at $1 trillion, all right? When I look at PEs, of course, we look at valuations, but
that's the value of the company as a multiple of the profits it's making.
Yeah, exactly. So we look at price-earnings ratios, right? But I think markets are quite psychological. And so there's things that you just think, And so the fact that Tesla is valued at $1 trillion, and there's not many companies valued at $1 trillion, and if you look at its sales and profits, they barely exist, it really shouldn't be. And that makes me think it's a bit toppy. The Bitcoin, we haven't gone there, thankfully, but the whole, but all of that makes me think markets are toppy.
This is a question, actually, from Brendan Keelan. He's wondering...
You can answer this one, Gerard.
Well, no, but this is a fairly standard question here. I mean, Brendan's asking, do we need to worry about cryptocurrency? Do you regard it as a sort of an extreme high-risk investment, which you should only do... Basically, it's like akin to gambling?
Is it an investment?
Or is it something... Well, exactly. Is it gambling or is it an investment? What are your thoughts, Gerard?
Coming back to the markets, you were saying a key factor is confidence. So any economy or market is influenced by the fundamentals, policy environment, and confidence comes into play. But when one starts talking about cryptocurrencies, it's more the latter. It's that confidence aspect. I think the whole backdrop to cryptocurrencies needs to become far more developed in terms of what central banks are going to do in terms of digital currencies and how that will affect the whole infrastructure, the whole environment. But if you're looking at cryptocurrencies in isolation, just look at the price movements in the last few weeks or few months. They're speculative, unpredictable, and that suggests that they are not a stable investment. Doesn't mean that you can't make money in them. It doesn't mean that you can't lose money in them. But when one looks at this whole area, though, there is a different dimension, and that very much depends on which way I think we're going to go in terms of digital currencies, and there's a lot going on with central banks across the globe. But if you look at cryptocurrencies in isolation at this moment, I would be saying, look, good luck, but don't make that a key part of your investment. Make that a sort of small part and view it as something that you're prepared to lose if you go into it.
Okay. So we've got a question about retirement, given that you mentioned it. So Rob is saying, considering retirement, when should he start to move away from mid-stock investments and start to look at other strategies? I mean, right now, you can see if you're 25 years old, Louise, you can think, okay, I'm going to check everything in high-risk strategy. I'll do it. I'll start to worry about that in 30 years' time. But as you start to get
switching from equities to bonds.
Yeah.
Yeah, I don't know. I'm still pretty punchy in equities, even if I get to an old age, to be honest.
I would say, the traditional view 20 years ago would have been, as you get older, put it into bonds. But as you've touched on,
why
bonds,
bother?
But what I would say, look, we have on Netwealth, again, I'm plugging Netwealth, but on the website, if you go on and sign up, you can actually go on to this app. It's quite sexy, and you can start to put in your where you are, how much money you have, and then coming back to Rob's question, it's about drawdowns. It's about how much you want to draw down each year. You can actually get a profile of how your investment is going to move, and that will give you a better idea. It then allows you to think, do I want to have a proportion in very low risk, so risk 1 or 2, so it's a very low return, and also have a proportion in higher risk, because I think the markets look quite attractive at the moment. So the point is that it's not a hard and fast rule. It depends on your individual circumstances. But you can now, thankfully, have these apps that help you guide your decision. But it's not a case of moving everything from here, equities, to over here, bonds, and that would be the wrong thing to do.
The irony now is if you look at what used to be considered low risk, which is a cash ISA. Yeah. You were saying, Louise, it's quite a high risk because it's going down quite a lot. So this sort of changes people's opinion as to what the definition is of a safe investment.
Well, also, it's the cost of safety. Okay, so that's what you have to bear in mind, right? So when the cost of safety was your money kept up with inflation, that's all right, isn't it? Like the money keeps up with inflation, that's fine. But remember, you might retire at 65. You may live another 20 years. So the cost of safety, if you put it into bonds, could be that your purchasing power of your money goes down 20%. Mm-hmm. The cost of that safety by dumping it into gilts is massive. So if you're happy to see the purchasing power of your money go down by 20 to 30% in your last 20 years of retirement, absolutely put 100% of your money into bonds.
Yeah.
But most people don't want that cost and don't understand the inflation eroding power.
And the compound, that sort of minus 10% figure you've shown us over the case of a decade. So,
and most people don't get that until they're actually in it, and they suddenly go after 10 years of retirement, oh my word, I can't afford my weekly shopping bill. And that's when you understand how inflation erodes the value of your money if you are not getting, if you're not even matching inflation. And that, I'm afraid, the cost of safety is so large, I will be 80% invested into equities until my dying day.
If we take this,
I will be.
If we take this, I completely agree, actually, in terms of how you've described it. But we can take this further in two different layers here. The first layer is people's money. People have different financial situations, but normally, well, people viewing probably have three pots, as we would say. Pot one is their sort of cash, they're coming in, their liquid stuff that comes in quickly. Pot two is the discretionary wealth that you can start to come to someone like Netwealth or whoever you choose to go to and use that to diversify. Your pot three is sort of the fixed bit, your house, etc. The fixed, or for some people it might be if they've worked for a company all their life, it's the shares in that company. The next layer, though, that becomes the real challenge is linked to one of your opening comments about the budget and taxes. If we don't get the economic growth we need in the UK, then the challenge is that the Chancellor is going to start coming looking for it. Not this Chancellor, maybe, might be someone else. And wealth is being talked about in terms of being taxed. In terms of a global tax system, the things that are mobile are normally the things most difficult to tax. Skilled workers, multinational companies, although there's attempts to sort of address that. The things that are not mobile become the easier things to start to think about taxing, property in particular. Now, therefore, investors need to be, or savers need to be thinking when they're looking at pensions, not just about their current discretionary wealth, but also their properties, and they need to be thinking about the tax environment as well. Currently, controlling the controllables is managing your tax liabilities by taking out ISAs, etc. But passing on your wealth, if you're in that lucky enough position, is also something. But we now have an additional challenge, the future wealth tax issue. I'm not in favour of wealth taxes.
But the thing is, wealth taxes are very difficult to get. There's a question from Yvonne here saying, is long-term investment in property still a good approach? Now, in property, typically, it's been a hedge against inflation. So people have thought that. A lot of people think their home is their pension. That they're going to borrow to the hilt, they'll put it in the stock market, they'll put it in the property market, and if average house rises at X amount more than average wages, then that's a pretty good investment. Now, you're saying here, Gerald, first of all, watch out for property taxes. By the way, the other thing I guess we have to look at here is the cost of net zero. Some people are saying that the government's going to stop you putting your house in the market unless you've done all of these various insulation things. So all of a sudden your house might not quite be as liquid as people first imagined. But when it comes to a wealth tax, when you look at the people talk about this all the time. We hear it, the Labour Party talk about it, the Tories talk about it. But it tends not to happen. When Dennis Healey was Chancellor, he tried to do a wealth tax. He looked at it very closely.
I'm agreeing with you. I don't think it will happen.
Because it was impractical.
Yeah. But
you're talking about it as if you think it is a risk.
Well, it is a risk, and it is a very solid risk. But I think we will avoid it because I think the economy will start to grow at a stronger pace and would start to actually avoid having to go down that route. But coming back to property in a different aspect, there are a number of countries across the globe that share the current UK view that property prices only go in one direction. Japan used to think that way, and I think property prices fell for about 21 years.
Nothing ever goes in one direction, right?
My parents came from Ireland. I remember you used to go back to Ireland a few years before the property bubble burst, and you start to see properties appearing in the middle of Westmeath, and you think, gosh, that was a field last year when I was here. They took years before the property market adjusted. Same in Spain. Consequence of the Euro system, the money goes to look for a high yield because there was no currency risk.
In Japan, but still nowhere near. Are they still below the peak of the 80s in Japan? I think they might be.
Yes.
Right,
I'm pretty. I says that so quickly,
right,
thinking
but,
of myself.
Japan stands as a monument. First of all, we talk about China's growth as if it's inevitable. Japan shows us how that growth can collapse. But also, people talk about property as if it's a one-way bet.
It's never a one-way bet. And I've always hated this idea of getting on the property ladder because it conveys the wrong impression. But what you have in London, that is linked to our global-ish picture as well. 20 years ago, it used to be local supply, local demand. Now it's local supply, there might be more of it, but it's global demand. So that international dimension clearly has had an impact on London. It probably will have an impact on our other cities, Birmingham and Manchester, particularly as levelling up takes place. But in the UK, we have the additional issues, the globalisation aspect tends to underpin property prices. But that, notwithstanding that, this can still change, particularly if the global environment changes or we decide to tighten up on migration flows.
Let's look at, international air travel down a lot, globalisation, world trade going down. I mean, we're now, aren't we, Louise, back into the language of trade wars. People are talking about, we might even get a carbon tax, for example. A carbon tax on the border would be a pretty big tax on Chinese goods. I mean, you can see an environment where the things that have powered for the last 20 years, globalisation, easy movement of people, goods and labour, that moves into a new period where things are moving a lot more slowly. And I put it to you that the last 20 years might be the best 2 decades we're going to see for quite some time. That right now, the next things are going to be a lot more difficult now.
Economically, I'm not sure I agree with that, although the build-up of debt during these two crises is not good for long-term growth.
Debt or personal debts?
Corporate debt and government debt, but particularly corporate debt. So we talk about the stock market not being representing the economy. So the stock market is the big companies, right, who can take advantage of bond markets where yields, interest rates are very low. What we need to focus a bit more on is the overall economy, small and medium-sized companies, which are clearly heavily indebted from this crisis. Probably, I would argue, they still have a bit of debt overhang from the global financial crisis. And all of that debt means that their opportunities for growing are limited. If they're having to pay back the interest on their loans, they can't hire new people, they can't invest. And so I'm still pretty bullish, and particularly for the FTSE, because the FTSE does not represent the UK economy. But one of the things we saw lower growth after the global financial crisis, lower GDP growth, that was structurally, it's now lower. After America and Europe in the UK, the growth level reduced after the global financial crisis. Currently, we have loads of fiscal stimulus, but I do wonder this build-up of corporate debt and government debt, how much that will slow our future growth. And that is something I have been pondering. Was that a fair thing to say, Gerard? Yeah. Am I correct to ponder on that?
I think you're right. I think we're
I'm
both
so glad you said that, Gerard.
This is a massive question because when we look at the amount of government debt right now, it's absolutely unbelievable, isn't it?
Yeah.
I mean, and right now, when in doubt, the Prime Minister used to advise he just borrows like there's no tomorrow. He borrows like a drunken Keynesian every single time.
John Maynard Keynes was the greatest economist this country has ever had. And I gave a talk at Charleston in the summer about Keynes. But Keynes actually would have been worried about current situation. Keynes would have argued that in good times you actually run surpluses.
We haven't run a surplus for a long time.
The point is that
2001.
the point is that it's not wrong to spend in difficult times. It's that you should make yourself in a situation where you're in a better position to spend. Global public debt is high. It's an all-time high. So it's not just a UK problem, which reinforces Louise's point.
Let's look at interest rates. Sure, the debt is high, but let's look at the actual in the bank, whether it's individually with the interest you're paying on your mortgage every month. House prices are huge, but look at the actual cost of buying that house. In other words, the cost of interest payments. They're actually historically quite low, quite affordable. Absolutely. The same with the government. Sure, it's borrowing £2 trillion, but look at the interest payments as a share of GDP. It's pretty low right now. So do we really need to worry, as Louise says?
But they're that low because the Bank of England indulges in quantitative easing and lowers the interest rate. So essentially you've got one bit of government borrowing, the other bit of government's not really part of government, but the other bit of government say you can borrow really cheaply. If we didn't have QE globally, I seriously wonder if the UK government could borrow at 1% a year.
No, yields would be higher.
Yeah.
It comes back to the earlier point about central banks have distorted the price at which governments can borrow. But there's no doubt, coming back to your question, that low inflation, low yields and low rates make it easier to borrow. The question is where we go from here. Now, debt to GDP in the UK, depends which measure you use, but let's use the latest one from last week, 98%. You take out the central bank, it'd be slightly lower. But debt to GDP after the Second World War, for an obvious reason, was much, much higher, 250, 260%. But the point is that we in the UK got, before our time, but got debt to GDP down to roughly 100% by the early 60s. It went down even further throughout the 60s. But that's because we had economic growth.
And coming labour force returning from fighting the Germans.
Well,
there's no real comparison.
There is a comparison because the labour force returned after the war, but the debt kept falling for 25 years. The debt kept falling as a proportion of GDP because we kept growing the economy. And it comes back again, all of this is predicated on what happens to economic growth. If economic growth picks up at a more sustainable pace, more rapid pace, then the debt to GDP picture can come down. And you mentioned the global financial crisis. Before the global financial crisis, and we don't talk enough about the global financial crisis in the UK because it's still impacting us. Before that, our trend rate of growth in the UK was around 2.25%. So that meant the economy would double in size, take out inflation in 32 years. By the time of 2016, so before Brexit referendum, first time the B word's been mentioned tonight, but by then, so nothing to do with Brexit, the trend rate of growth was down to roughly 1.3, 1.4%. And that meant that the UK economy would take 60 years to double in size. So we haven't really addressed the challenges from the global financial crisis, never mind the challenges from this pandemic. But if growth doesn't pick up, then the worries about debt come to the fore. If inflation picks up, then yields and rates pick up, and these problems become very acute.
Statistic, Louise,
I love that statistic, Gerard. I'm going to use that. I love that.
But doesn't it rather rain on your parade? Because here you are saying how cheap Britain is and how we should be investing in our domestic stock. But look at the dismal growth rates Gerald's talking about. This doesn't make me feel optimistic.
The FTSE 100 does not represent the UK economy. All right, I cannot keep that. Stock markets don't represent. Yeah, I mean that is the something.
You said your Vanguard fund that you're so fond of is about 40% invested in UK equities. That won't just be the FTSE 100. It'll be the all share.
Okay, so again, I go back to the FTSE 100 gives you 3 to 4% dividend yield. So even if the FTSE goes nowhere, I'm still getting 3 to 4% a year. If I invested in bond markets, I'm not getting that. So 3 to 4% a year, that keeps me up with inflation. I'm happy with that. Clearly, I would like more. We always want more. But again, I don't have a lot of choice in a world where central banks are manipulating interest rates so much lower because of QE. You are completely right, Gerard. Because of central bank's QE, risk and return are priced wrongly. Yeah. And so therefore, I have no choice but to park all my money into equities. If I was getting what used to be the 10-year yield on gilts was about 5% pre the financial crisis, if I was getting 5% a year from a gilt, I'm pretty happy with that. A little bit of inflation covers inflation, a little bit on top. Bob's your Bob's your uncle, I'm happy. But I'm not getting 5%, I'm getting 1%. And so it forces you into equities. And I do keep reiterating the FTSE 100 is not, or even the FTSE All Share, is not the UK economy. These are large companies that can borrow cheaply. These aren't the small and medium-sized companies that make up a lot of our economy that are so overly indebted at much higher interest rates.
Okay, so going back to our original question then, in spite of all this volatility, is now a good time to invest? And effectively, Louise, you're saying is always a good time to invest.
It's always a good time to invest if you are nervous. So was it Jenny who was asking about her cash ISAs? So what I do is I invest every month. So I just keep dripping the money in. If you're worried about buying, if you're worried about timing the market wrongly, you just say, right, I've got...
And low fees are key, whether it's Vanguard or Netwealth. That's another key.
Yeah, so you just keep putting your money in month by month, and then if the market does crash, you cannot predict when the market's going to go up or down. If the market does crash or it does roar ahead, you're just dripping your money in month by month. So if you are worried about market timing, that's how you do it.
And given that both of you are talking about long-term investing, but just as a matter of interest, by this time next year, the chances of some kind of crash, financial crisis, what would you say, Gerard? 10%, 20%?
Well, yeah, exit strategies from current cheap money and high debt policies are sort of a key issue that have to be taken into account. Central banks, people assume...
You've been asking the Bank of England to not raise rates, but tighten its policies. In other words,
quantitative
you want to start.
The best way to think of the central bank is for the last year, it's driven a car with its foot on the accelerator. There's been one warning sign, costs ahead, another warning sign, inflation ahead. It's gone through, and now we're at the bottom of a steep hill with cost of living crisis. It's deciding to put its foot on the brake. They haven't driven the car well. That's why I would be concerned. We've talked about inflation, but it's also financial stability risks. If you look at where these might come to the fore is where the central bank might make a bigger mistake.
I was chatting to a gilt trader earlier this week, and there's as the central bank should always be ahead of the curve, ahead of what is happening. And there is a definite feeling that the Bank of England currently has missed inflation, is behind the curve, and the credibility of the Bank of England from the perspective of gilt markets, our government debt markets, is really quite poor at the moment. Is that a nice way of saying it?
I was at a lunch yesterday and someone else basically said the Bank of England is no longer in the first division of global central banks because of what's happened in the last couple of years.
Well, they might not be ahead of the curve, but Gerard Lyons and Louise Cooper, both of you, I'm sure, are. So thank you very much for joining me this evening, and thanks to all of you as well watching at home to ask those questions. And a final thank you to our sponsors, Netwealth. Now, if you enjoyed this show from Spectator TV, remember you can get more like it on our Spectator TV YouTube channel, where our journalists speak to politicians, pundits and experts every single Thursday at 6 p.m. and round up of what's happened that week and what's happening the next. And also you can subscribe to The Spectator itself at spectator.co.uk/voucher. If you go to that URL, you'll get a £20 Amazon voucher absolutely free. Thanks for watching and have a great evening.